All right, joining me now, J.P. Morgan Chief Global Strategist David Kelly. David, first and foremost, I'm a huge fan. I'm glad you're on the show.
Very happy to be here.
All right, so you and I, of course, know there's pullbacks, there's corrections, there's an occasional crash, all part of long-term investing. But there is some pain associated with the process, right? And the anxiety. Are people right to feel sort of anxious about what's happening right now?
I think people are right to be cautious because we've had a huge run-up in the stock market. I think the fundamentals are still very good. I realize profits aren't growing significantly, but they're at a very high level. We saw profits soar really over the pandemic years, and now we're sort of just treading water. But they're at very high level. The economy is still growing. It looks like it's growing between 2 and 3%. We've added 3 million jobs. Unemployment rate's at 4%. Inflation is a little sticky, but overall it's still on a downward trend. So overall it's a good economy. The issue is, though, market's gone up a lot, and as you said, it will have corrections, and people just need to be aware of that as long-term investors.
Right, and so do you sense that's, for instance, what are you saying to folks who are saying, okay, we're getting it feels a little toppy here near term. Are you taking any actions, or do you have some ideas on the drawing board?
It's not so much about the when as the what. I think people need to think about things that are fairly valued and things that are overvalued. So if you look at some of the mega cap stocks in the United States are, I think, overvalued. They've had a huge run-up, but those are very high multiples for very big companies. But outside of that, if you look at the rest of the market, it's not really overvalued. If you look at non-U.S. stocks, they're certainly not overvalued. I think there are plenty of opportunities around the world.
Although, though, I mean, the sort of like emerging markets and those kind of things, they've been cheap versus the U.S. for a long time, and you could have taken that bait and watched the rest of this market. And, okay, we know the Mag 7 or the top 10 or even the top 20 names have an overabundance of influence, but they also have delivered, right? They have been the engine of growth and earnings. The rest of the market, despite the economic backdrop that you described, they haven't really stepped up.
No question. But I mean, you've got to distinguish between the wave of earnings and the foam on top of the wave, which is sort of the level of valuations. And some of these companies, I'm not going to mention particular names, but they've got a level of valuation which is just too high, even given that optimism. So it's important to not get carried away by this. All
right, coming into the year, your macroeconomic forecast, of course, 2% GDP growth, 0 recessions, 2% inflation, and 4% unemployment, give or take.
Yeah.
And, of course, that's your 2024.
Yeah, that's right. That was my forecast.
I like it.
2024.
What on there is starting to look a little shaky here?
Well, I feel good about 2% GDP growth. We might do more than that right now. 0 recession still there. 4% unemployment. This is the 28 straight months with 4% or less, so I feel good about that. The inflation does seem to be a little stickier, so I think we're more likely to end the year closer to 2.5% than 2%. So it's moving, but we're talking about decimals here. It's still a very good economy.
So let's say this moves in this direction, and then all of a sudden, so does unemployment, because that FOMC meeting, Jay Powell, in the presser, he mentioned a shock to jobs. It was weird because he brought it up on his own, unsolicited. Yeah. And, it sounded like not a large shock. So we pulled back this last jobs report, unemployment 3.8% from 3.9. But I feel like it seems to me he's saying if we go 4.1, 4.2, that could send off alarm signals. Would that bother you? But because it seems like the Fed would take action.
It would bother me if we were losing jobs to get there. If it's still more people piling into the labor market, and we've seen a big increase in labor force participation among working age people. If that's just people piling in because they know their job's out there, not going to worry about that. But if it is job growth slowing down to 100,000, 50,000 negative, then of course it's a problem.
And the good news for what you're describing is the more people that come back in, the little bit more power employers have, and that could keep it capital.
That's right.
Earnings.
I mean, this is what's giving us a longer, wider soft landing. It's that workers are not demanding these huge wage increases. I mean, real wage growth is positive, but they're not. There've been no major strikes so far this year. There were last year some strikes, but there were no major strikes so far this year. So workers seem to be remarkably quiet and just basically working here, and that's helping the economy grow.
So for the most part, for the investors watching, this is just a part. We've had a huge run up for a long time. This is more consolidation kind of thing than anything else?
That's right. But then look at where your portfolio is. Because, for example, you may be completely underweight international. And maybe, in the long run, if the dollar comes down, then you will get better returns in international. You may also have no alternatives in a portfolio. It's good to have alternative assets as well as stocks and bonds. So the things people should do.
Real quick, I was supposed to ask you about this, the dollar, because you wrote a big piece on the dollar. And, the day the Bloomberg saying King dollar is becoming a bully, there are a lot of headlines around the rest of the world suffering because of the dollar you can see what's happened with all of these other currencies.
Yeah.
They're getting hammered tough, big time because of the strength of the dollar. In the meantime, candidate Trump, former President Trump, saying he would actually take action to weaken the dollar. Now, I know every president's supposed to say they like a strong dollar, but there's a limit to the strength of a dollar. Where do you see the dollar going?
Well, I agree that the dollar ought to come down over time. It is too high because we're running a big trade deficit. It really did hurt manufacturing. And I much prefer an idea of slowly bringing the dollar down to a more reasonable level than tariffs, because I think tariffs slow down the whole global economy. They're just, But also, if you want a slightly weaker dollar, what you're really saying is you want stronger currencies in Europe. You want strong currencies in the UK and Japan. So the more that we can help Europe, for example, get past the Ukraine war, or help them be stronger, the more we can help our allies, actually, that'll naturally bring the dollar down. So I think by helping other countries, we may actually help achieve this.
You're eternal optimist. I feel like, I don't know, Europe may be a little late there. I don't know. Great having you on.
Oh, anytime.
This is a Wall Street legend, folks. Thanks a lot. Appreciate it.